How's everyone doing? Welcome to the Banker Next Door. You are in the strategy room on this Saturday night, May 10th, 2025. Great to be here. I have an awesome show for everyone tonight. We're going to be talking about the Federal Reserve's decision this week. We're going to be talking about tariffs. We're going to be spending some time talking about what's going on with China, specifically their economy. We've got so many things, a bunch of ancillary stories, crypto, different things going on. So all kinds of stuff to throw at you guys tonight, as well as the usual conversation on economic indicators and episodes that came out this week. So can't wait to get started with everybody. But one thing I wanted to share with you guys tonight to kick us off was I got merch. not for sale yet, but I actually had our first run of our t-shirts, and this is a white one here. So this is kind of the front of the t-shirt, and then I think the back came out really good. So I think if everybody can see that there pretty good there. So Banker Next Door, and then you see there pretty good. I am actually wearing the navy blue. I'll kind of stand up so everybody can kind of see the front of that there. I actually like the navy blue. I thought the navy blue actually came out really good. So, but these are, like I said, these are not up for sale on the website yet. I don't have a store on the website as of yet to sell any merch, but working on it. And if anybody by chance would be interested in getting a t-shirt out there, just let me know. You could send me a comment or send me a DM or send me an email at info@thebankernextdoor.com. I'd be happy to get you guys a t-shirt. They'll be on sale for $99.95, or we could do the QVC thing, 4 easy payments of $199.95. just messing with you. Yeah, no, obviously I'd be lucky to sell these things for $5, let alone $99.95. So yeah, but hopefully everybody found a little humor in that just for a minute there. So but anyway, all right, let's kick off the evening here then, shall we? So I thought this was really fascinating. Obviously, a lot of news last week with Warren Buffett deciding that he was going to step down by the end of the year as the CEO of Berkshire Hathaway. He's still going to remain the chairman for a little while, but he's stepping down as CEO. He's going to turn over all the day-to-day operations to one of the other gentlemen there. But just look at this return, though. Warren Buffett's return tally after 60 years, 5,502,284%. That is just insane. It's unbelievable. And I just had to show, amazing. It just escapes all reality. There are, professional hedge fund managers, private equity people, traders for the major banks. There's so many people out there, so many pros that do this. And, if they averaged, a 20% return over their span of their career, they would probably all say, oh my gosh, incredible job, well done, amazing work. But this return is just incredible. So Berkshire Hathaway shares have skyrocketed again, 5,502,284% since 1965. By comparison, the broad S&P 500 has risen 39,054% during that time period. So, not even close, not even close. So, and this article just says, when Warren Buffett relinquishes the CEO title of Berkshire Hathaway, he will leave investors with decades of outsized returns. Buffett shocked the investing world on Saturday with a surprise announcement that he intends to step down from the chief executive post by year end after 6 decades. Berkshire's board approved this decision, with the billionaire continuing his other role as chairman. He will pass the CEO baton to designated successor Greg Abel. The stock's performance shows a legacy of moves under Buffett that has allowed Berkshire stock to run circles around the broader market, even when including dividends. In other words, the proof is in the pudding. So it's just unbelievable. Berkshire's monster figure equates to a compounded annual return of 19.9%. That is nearly double the 10.4% recorded by the S&P 500. So absolutely amazing performance. That outperformance has been driven by some years where Berkshire stock left the broader market in the dust. In 1998, for example, Berkshire surged 52.2%, while the S&P 500 advanced 28.6%. Berkshire shares soared 129.3% in 1976, far outpacing the S&P 500's 23.6% gain. In other years, Berkshire was able to sidestep declines that dragged on the market as technology stocks led a market meltdown that pulled the S&P 500 down 18.1% in 2022. Berkshire was able to end the year with a 4% increase. In 1981, while the S&P 500 slid 5%, the Nebraska-based conglomerate rallied 31.8%. There were some periods where Berkshire lagged, most recently as the S&P 500 rebounded 26.3% in 2023. The company's stock added just 15.8%. Berkshire finished 2020 higher by 2.4%, underperforming the S&P 500 by 16 percentage points. Still, Jeremy Siegel, a finance professor at the University of Pennsylvania, noted Berkshire's ability to outperform the S&P 500 by nearly 2% over the past decade. Yeah, I mean, just absolutely unreal performance there. Warren Buffett, love him, hate him, not like him, whatever. The guy is an absolute legend in the business world, in the investing world, and there's no doubt his track record has been studied for years and years and years, and it will be studied for years and years to come. Just as Benjamin Graham, his teacher, his investing approaches have been studied for decades. Like I said, Warren Buffett's his investing, his wins, his losses, it'll all be studied for a long, long time to come. So just absolutely amazing. And I did want to share this. I thought this was really interesting. So Buffett says recent market volatility is really nothing and urges investor calm. So the 94-year-old Berkshire CEO also revealed that he plans to retire at the year end. We got that. But, it was really interesting. So Warren Buffett on May 3rd urged long-term investors not to be shaken by short-term swings and focus on fundamentals amid recent market volatility. What has happened in the last 30, 45 days is really nothing. Buffett told shareholders at Berkshire Hathaway's annual shareholder meeting on May 3rd in Omaha, Nebraska. This has not been a dramatic bear market or anything of that sort. Buffett made clear that wild market swings, while unsettling in the moment, are nothing to panic about. If it makes a difference to you whether your stocks are down 15% or not, you need a somewhat different investment philosophy, he said. The world is not going to adapt to you. You're going to have to adapt to the world. He reminded attendees that Berkshire Hathaway stock has dropped by 50% 3 times in its history, and each time the fundamentals of the company remain sound. People have emotions, he said, but you've got to check them at the door when you invest. So yeah, again, excellent advice. And it just goes to show you, it's kind of what I've been saying about the stock market recently, about all the changes going on with the tariffs, things that Congress are working on with potential tax treatments, other things, just a lot of upheaval. Obviously, President Trump coming with a tremendous amount of executive orders, a lot of things happening in the first couple months of the Trump administration. So, and the stock market went down a little bit, but now it's basically completely bounced back just about. And and that's, I think this is the message, and this is what I've been saying for the last couple of months, is basically like, don't panic, we're gonna have ups and downs this year. Don't worry about it. It will be fine. And again, I think again, Buffett, I think here does a great job of just seeing through the noise, seeing the forest through the trees, like realizing that, hey, look, there's just some things going on right now, but this too shall pass, and everything will find a way to settle down and kind of work itself out. So, okay, that being said, let's take a look at the debt clock here, as we do every week to the beginning of the show, and let's see how we're doing. So our national debt still blazing toward $37 trillion in national debt. Our annual U.S. budget deficit still sitting at a little over $2 trillion. The Doge clock is now over $416 billion, with savings per taxpayer of $3,705. Now, again, I question this number because of reporting that I have done over the last few weeks, and that is, Doge basically claims that they've saved about $163 billion, which is great, but it's certainly not $416 billion. So I do have some question as to where this calculation is coming from. I've said before, I hope this is true. I would love this to be true, but I don't know. I just don't know. There's a lot of numbers being thrown around right now, and I think we just have to wait to see what happens. But I think what is evident is this point is that there's not going to be Doge is not going to find $1 trillion. I mean, they're not going to come even close to that. And and again, I think that's okay. I think if Doge keeps doing their thing, they'll still have a lot of great things to talk about in the end. I mean, we've always known that at the end of the day, Congress was going to have to be the one that was going to have to go in there, and that's their job. And they were going to have to go in there, and they were going to have to make serious cuts. And again, I've said this for a while. I don't think they're serious about cutting any money, either both sides of the aisle. I think both sides of the aisle are not serious about it. But and that's, I think, thus far I've been proven absolutely right that they don't want to do it. I think in some respect they were hoping that Doge was going to do their job for them. That Doge was going to come in and Doge was going to find $1 trillion, and then that was going to take them off the hook and say, oh, geez, whatever. I mean, they don't even like to pass legislation. They like to let the Supreme Court do all their work now, which is amazing in and of itself. That's how pathetic Congress has gotten. But anyway, so that's where we're at with Doge. I just wanted to point out a couple things here. So this is the Doge website, doge.gov, and they do put up things here, and mainly a lot of this is posted on X, but they put it up here. And so, I mean, again, they are working on a bunch of things. So collaboration win by the US OPM and Doge after 35 plus years of failed modernization attempts. OPM has announced that as of June 2nd, they are replacing their 65 plus year old paper process with an all digital alternative. This will reduce the average time people wait to receive their benefits, their retirement benefits mainly. But again, that's great. Like, good thing. Okay. More on that. Department of Energy contract update. Look, over the last 2 days, agencies terminated 522 wasteful contracts with a ceiling value of $285 million and savings of $110 million, including a $181,000 USDA contract for a technical climate advisor for Central Africa. So, again, just like great. And then this next one, credit card update. So the program to audit unused, unneeded credit cards has been expanded to 32 agencies. So after 10 weeks, more than 500,000 cards have been deactivated. As a reminder, at the start of the audit, there were 4.6 million active cards and accounts. So still more work to be done. So again, that is great stuff. I think if they just keep on plowing through and doing a lot of stuff like that, in another couple of years, like they're going to have, created tremendous progress. So hopefully, like I said, I've been a fan of Doge. I love Doge. I hope they keep rolling with this. So, but okay, so let's move on. One of our big stories of the week here, obviously the Federal Reserve holding rate steady. Now, if you guys remember from last week, what did I say? I basically wrote the script of this meeting. I said Jeremy Powell was going to do nothing, and he was going to cry about tariffs, and there was going to be all this uncertainty, and inflation was still high, and he just couldn't possibly find any way to do anything. We still need to wait for rate cuts. Oh, it's terrible. Jeremy's got the SADs. But what do we say here? It says Fed holds rate steady as it notes rising uncertainty and stagflation risk. So the Federal Reserve held its key interest rate unchanged in a range between 4.25 and 4.5, where it has been since December. The post-meeting statement noted the recent market volatility and how that is factoring into the central bank's policy decisions. Uncertainty about the economic outlook has increased further, the statement said. Again, the Federal Reserve holding its rate steady. We can see here from the chart here, basically here we are at the 4.25%, where we've been holding steady here for the last 5 months with no change. And as I said, Jeremy is he's very concerned still about inflation, about tariffs, about the effects that, things that could go bump in the night, as they would say. He's worried about everything else, but not acting. Now, here is the official statement from the Federal Reserve. So let's read through this for a second. So all those swings and net exports have affected the data, recent indicators suggest that economic activity has continued to expand at a solid pace. The unemployment rate has stabilized at a low level in recent months, and labor market conditions remain solid. Inflation remains somewhat elevated. The committee seeks to achieve maximum employment and inflation at the rate of 2% over the longer run. Uncertainty about the economic outlook has increased further. The committee is attentive to the risks to both sides of its dual mandate and judges that the risks of higher unemployment and higher inflation have risen. In support of its goals, the committee decided to maintain the target rate for the federal funds rate at 4.25 to 4.5%. In considering the extent and timing of additional adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. The committee will continue reducing its holdings of Treasury securities and agency debt and agency mortgage-backed securities. The committee is strongly committed to supporting maximum employment and returning inflation to its 2% objective. In assessing the appropriate stance in monetary policy, the committee will continue to monitor the implications of incoming information for the economic outlook. The committee would be prepared to adjust the stance of monetary policy as appropriate if risks emerge that could impede the attainment of the committee's goals. The committee's assessment will take into account a wide range of information, including readings on labor market conditions, inflation pressures and inflation expectations, and financial and international developments. So again, very predictable, very predictable statements here from the Federal Reserve. And I just want to point out that this was a unanimous policy vote. Again, the Fed emphasizes the stated risk of higher unemployment and higher inflation have risen. The Fed noted they will continue monitoring economic information and are prepared to adjust monetary policy in order to meet their dual mandate goals of maximum employment and stable prices. So again, like I said Jeremy was going to do nothing, and that is basically exactly what happened. And it's frustrating. It's very frustrating. I was really hoping for what the Fed deems as forward guidance. I was hoping that we would at least get some kind of indication from Jeremy that, hey, if things begin to worsen a little bit, or if inflation really comes down, we may look to begin to reduce interest rates a little bit, maybe toward the end of the year. But no, we got none of that from Jeremy. Jeremy basically just, again, he took his ball and he went home and he basically said, nope, sorry guys, I got nothing for you. That's just how it is, and deal with it. And it's very frustrating. It's very frustrating right now. And so we'll see. Let's look at a couple other things here real quick. So why the Fed isn't ready to join other central banks in cutting rates? Oh, did I mention that just about every other central bank around the world is in the process of cutting rates right now because they see the issue of the tariff war, trade war that the press has made such a big deal about. And so their countries feel the need to help out their economies by cutting rates and doing whatever is in their central bank toolkit to try to help their economies, but not ours. Jeremy, he can't possibly do that. So the U.S. faces risks of higher inflation and unemployment. Countries without tax hikes on imports are focused on the hit to growth. Oh, interesting. Okay, so Powell emphasized the Fed is in no rush to cut rates, using weight repeatedly to highlight official stance. Trump's tariffs have caused a divergence in monetary policy between the U.S. and other rich countries. Unlike 2019, the Fed is wary of preemptive rate cuts due to recent high inflation. So Federal Reserve Chairman Jeremy Powell played down any impressions Wednesday that the central bank was looking ahead to cushion economic weakness from President Trump's tariffs by cutting rates. At a news conference, he used some version of the word wait 22 times to underscore how the Fed isn't in a rush. The costs of waiting to see further are fairly low, we think, so that's what we're doing, Powell said. Powell's comments, delivered after the Fed agreed to extend its pause on interest rates, laid bare how Trump's unpredictable and mercurial trade announcements have opened up a divide in monetary policy between the U.S. and its rich country peers. The reason for the divergence is straightforward, apparently. Those other economies haven't imposed large tax increases on imported goods. Oh, well, that's because they didn't have to, because they already have all their tariffs on us. They didn't have to do that. But of course, the good people at the Wall Street Journal forget to mention that. As a result, they are seeing the effects of softening demand and weak labor markets, but without the effects of higher prices that Fed policymakers could grapple with later this year. Moreover, because the economy has just been through a wrenching period of high inflation, Fed officials don't think they can risk cutting rates preemptively to support a slowdown in hiring, lest it add to hotter price pressures in the short term. But they could cut rates back in September during the presidential election, right? They could do that. But they kicked off higher inflation for the next 4 months thereafter. But right now, when inflation is coming down, there's no presidential election. Things seem to be somewhat okay, but obviously GDP came in a little weaker, and they could be doing something. They could be taking some 25 basis point rate cuts over the next 5-6 months. But no, they're not. They're not going to do that. They're not going to do that because they're afraid of everything under the sun that may or could happen in the next 40 years. Fed officials remain focused on possibility tariffs will spur inflation. So the Federal Reserve officials speaking Friday emphasized the risks that tariffs imposed by the Trump administration will stoke inflation. The Fed, which manages the nation's monetary policy with the goal of keeping inflation and unemployment in check, may find itself in a bind if it has to choose between lowering interest rates to boost the economy against a tariff-induced slowdown or keeping them high to control inflation. One policymaker defended the central bank's independence from political pressure days after President Donald Trump reiterated his criticisms of Fed Chair Powell for not cutting interest rates. So basically on Friday, you had a bunch of Fed governors ran out, basically gave speeches, supporting Powell. You had John C. Williams. Who else we had here? We had Adrian Kugler. So there was 3 or 4 of them that basically came out, and Michael Barr, said it was unclear whether the tariffs would do more damage on the inflation or the employment front. So he favored waiting and seeing which emerged as a bigger threat. So, well, again, we've got more inflation data that's going to be coming out this week, but the inflation data that we got last week and everything we've seen for the last 3 months basically is showing that inflation is actually coming down. Why? Because the economy is slowing. So again, there's all this fear that there's going to be all this inflation, whatever. And as I've maintained before, tariffs do not cause inflation. Price increases, okay, because somebody got a new tax, okay, is different than inflation. Inflation is only caused one way, and one way only, and that is from the government spending money, okay? The Biden administration spent money like crazy, and they took that money and they put it directly in the pocket of the consumer, and that caused massive inflation. And that's how you get inflation. You don't get inflation from tariffs. Tariffs are a tax. They're a tax. It's not inflation. So this argument to me that the tariffs are going to spur all this inflation, it's a joke. It's a joke. But let's continue on here because I'm going to get to a point here. I just need everybody to bear with me here for a few more minutes. Wobbling economy will push the Fed to cut interest rates later this year, CNB survey finds. Asked how the Fed will respond to not only higher prices from tariffs and weakening growth in employment, 65% said the central bank will cut rates. Only 26% said the Fed will hold rates when faced with the stagflation dilemma, and just 3% believe the Fed will hike rates. The odds of recession in the next year rose to 53%, up from 22% in January, for the biggest 2 survey increase since 2022. So, amid a decidedly stagflationary forecast, I didn't realize it had become decidedly stagflationary, including higher inflation and unemployment and surging odds of recession. Respondents to the May CNBC Fed survey still believe the Federal Reserve will cut interest rates this year and next. Asked how the Fed will respond to not only persistent higher prices from tariffs, but also weakening growth and unemployment, 65% said the Fed will cut rates to address the economic weakness despite the inflation. That's up from 44% in the March survey, when the majority thought the Fed would hold in that scenario. Only 26% said the Fed will hold rates when faced with the stagnation dilemma, and just 3% believe the Fed will hike rates. So again, a lot of people here, majority, think that the Fed will cut rates later this year, even though Powell gave zero indication that that is what he's going to do. What did the president have to say about this? Well, Trump says a rate cut would be like jet fuel for markets, but Powell doesn't want to do it. And I agree with Trump here. I think it absolutely would be a big if they cut rates. And again, they don't need to cut rates massively. We don't need to go back down to 0%. We don't need to go to 3 or 4, but 1 point. That's it. They need to shave 1 point off, and they need to do it in quarter point increments over a, say, 6 or 8 month period of time. Like every 2 months, they could do a quarter point cut for the next 8 months, and that would take it down a point, and that would get us to exactly where I think we need to be. 1 point. You need one point. So President Donald Trump derided Federal Reserve Chairman Jeremy Powell once again Thursday, a day after the central bank voted not to lower rates because of economic uncertainty created by tariffs. Now, if the chairman of the Fed, if he would lower interest rates like China did, like I think the UK did, but like numerous other countries have done, it's like jet fuel, but he doesn't want to do it. Trump told reporters, I think he doesn't want to do it. Probably he's not in love with me. I think it's sort of a crazy reason, but that's the way life is. The president began the day by calling the central bank leader a fool, then later saying it's like talking to a wall to get the Fed to ease monetary policy. It's a shame. I call him too late, pal. That's his nickname. Trump said late Thursday morning. It's ridiculous. He's always too late. I think, too late. Jeremy Powell is a fool who doesn't have a clue. Other than that, I like him very much. Oil and energy way down, almost all costs, groceries and eggs down, virtually no inflation, tariff money pouring into the U.S., the exact opposite of too late and joy. Everybody's cutting but him, Trump said of Powell. You know, the comments came after the Bank of England voted to lower its key borrowing rate another quarter percentage point. The European Central Bank also has been in cutting mode. Most other major central banks also have been reducing rates. The Fed said that it was keeping rates the same until the economic outlook becomes a little bit clearer. So everybody else is cutting rates, but we're not. Okay, so let me understand. So again, Jeremy Powell is late to the party, and again, it's what is frustrating here is that the problems that we have were created by the Federal Reserve. They're created by the Federal Reserve. And yet here we are, they're bemoaning the problems that they created, and we have to wait and see, until they feel it's necessary to do something. It's very, very frustrating. And then we go on to this. Powell may have a hard time avoiding Trump's too late label, even as the Fed chief does the right thing. Really? History suggests that President Donald Trump's new too late nickname for Federal Reserve Chairman Jeremy Powell has a strong chance of coming true. Really? Of course it's going to come true. It's absolutely going to come true. Fed leaders have been criticized as slow to act absent compelling data showing them something needs to be done. Powell is in a no-win situation that with threats to both sides of the Fed mandate, and that's why he's doing the exact right thing at this moment, which is nothing. Because one way or another, it's going to be a mistake, economist Dan North said. Now, wait, I need to read that again because it's got to be one of the dumbest things I've heard in a while. And that's why he's doing the exact right thing at this moment, which is nothing, because one way or another, it's going to be a mistake. So do nothing because one way or the other, it's going to be a mistake. Like it's unbelievable. And then again, once again, this is the business media out running cover for Powell because, heaven forbid, you should ever criticize the chairman of the Federal Reserve. They're always perfect. They never do anything wrong. It's ridiculous. History suggests that Donald Trump's new too late nickname for Federal Reserve Chairman Jeremy Powell has a strong chance of coming true, though he'd hardly be alone if it does. After all, central bank leaders have a long history of being too reluctant to raise or lower interest rates. Whether it was Arthur Burns keeping rates too low in the face of the stagflation threat during the 1970s, Alan Greenspan not responding quickly enough to the dot-com bubble in the 90s, or Ben Bernanke's dismal of the subprime housing prices as contained and not lowering rates prior to the 2008 financial crisis, Fed leaders have long been criticized as slow to act absent compelling data showing them something needs to be done. So some economists think Powell, faced with a unique set of challenges to the Fed's twin goals of full employment and low inflation, has a strong chance of wearing the too late label. In fact, many of them think nothing is exactly what Powell should do now. So, oh, that's great. Yeah. So, so he'll be wrong either way. And he's going to be too late. Trump's going to be proven right. So he should just sit there and do nothing. That's the answer. Amazing. Amazing. And the history is there. The history of the Federal Reserve always being a day late and a dollar short is it's long history. We have 100-year history of that. All right, wait a minute. Did I skip something there? All right, so I'm going to leave the Federal Reserve argument there for right now. I made the point that I wanted to make, that basically the Federal Reserve should be acting now. If they're not cutting rates right this minute, they should be signaling to us exactly when they are going to cut rates, when they're going to start cutting rates. Powell needs to do something there. And I want to show you guys, if you guys could bear with me for a second here. I want to bring something up here because I want to show you guys. All right, we'll come back to that. So here it is. There's two charts here I want to show everybody. I want to blow this up for a second here because I would love for the Fed to comment on this. If the Fed had maintained its rate of security sales from 23, it would have returned the balance sheet to pre-pandemic levels in a few years. But the runoff has now slowed so dramatically that it'll be decades before the balance sheet shrinks that much. So it'll never happen. So the Fed has I will give them a little bit of credit here. They have brought the balance sheet back down here, over the last couple of years. They brought it from a high of 9 trillion, and it's basically now coming back down to, somewhere in the neighborhood of about $6.5 to $6.7 trillion. But pre-pandemic, they were about 4.1 trillion pre-pandemic. So, and what the point here is that basically they could have, if they had been more aggressive in doing this, they could have brought their balance sheet back down to this $4 trillion level. But now this is leveling off and dramatically slowing down. And like you said, this is probably it's sooner or later this is going to stop, and you're probably going to end up around maybe $6 trillion here. And it's still, but even when the Fed's balance sheet was at $4 trillion, I basically looked at this, back in 2019, and I said this is never going to go away. The Federal Reserve's balance sheet's never going to be back down below $4 trillion. It's crazy. So all right, let's see here. There's one Fed chart here I wanted to show you guys. Oh yeah, this is a good one here. You guys will love this. Federal Reserve fighting inflation since 1913. So a 1 ounce U.S. gold coin in 2025, $3,334. A 1 ounce U.S. gold coin in 1933, $20.67. Look at that. Look at that. So this is the Fed fighting inflation over the last 100+ years, everyone. This is it right here. So a 1 ounce gold coin in 1933, $20.67. In 2025, it is $3,334. It's just, amazing. That's the inflation. So, and again, and that's why I said, people think they're richer, and in reality, you're not richer, you're poorer. People have, their house is worth $1 million, and they're like, oh my gosh, I bought this house 25 years ago, and I bought it for $250, and now it's worth $1 million. I'm so rich, and I'm getting richer, or whatever. And it's like, no. That house is still worth the same $250,000 you paid for it. It's just that the value of the dollar has decreased that much, that it makes it appear like things are going up in value when they're not. It's called asset price inflation. It's all right, come on, where is the chart that I'm looking for here? Oh, this was I got it. All right, this was the piece. Oh, that wasn't what I was looking for. I was looking for yes, here we go. The unrealized losses at the FDIC. Oh, no. Actually, that's not that. That was the losses at the FDIC. Where's the chart I was looking for here? Give me a minute here. Let's see if we can find this. Here it is. Okay, here it is. This is what I would have liked Jeremy Powell to talk about at the press conference. And you notice not one reporter asked him about this. The Fed is closing in on $250 billion in losses because of interest rate manipulations and quarantining trillions of dollars. These extraordinary measures were used to provide the Biden administration ample cash to spend while keeping the liquidity out of the private economy. So, I mean, $250 billion, $250 billion loss at the Federal Reserve. They've been losing money for the last 3 years with no end in sight, mind you, no end in sight. And yet, where was the questioning on this? Where was the questioning of Powell for, okay, what do you do to stop these losses? What are you going to do to stem these losses? I mean, just look at this chart. I mean, this chart in and of itself is crazy. It's like falling off a cliff. What was he going to do to stop the losses, stop the bleeding at the Fed, and basically, hopefully return them back to profitability? Because remember something, these losses are like they compound, and then they will take years of profits from the Fed to get this back, to get this balance back to even. This is basically just like digging a hole, and you just keep, that hole keeps just getting deeper and deeper and deeper. So it's crazy. But again, nobody wants to ask Jeremy about this. Let's see here. And I did have one other thing. There was one other great chart in here on the job. We got more jobs data that basically came out, more revision to the jobs report, which basically said that, I don't know all right, we'll come back to that later. Where are we at here? Okay, so I thought this was kind of interesting. I'll jump to this real quick before we'll jump into the whole tariff conversation here. So this basically says Trump backs tax hike on rich, but says the GOP should probably not do it. So President Donald Trump says he would back raising taxes on the richest Americans to help pay for domestic agenda. The politics of a tax hike are difficult for Republicans to stomach. Really, but so are the potential deficits that would result from enacting cuts without money to pay for them. Trump called House Speaker Mike Johnson about a tax hike and proposed a carve-out for small business owners, many of whom report business income on their individual returns. So, yes, I am actually all for this. If you are going to cut taxes in terms of, like, you're going to cut tax on overtime, no tax on tips. So if you're going to get rid of that, you have to replace it with something. And I'm in favor. Again, if you want to come out with some kind of billionaires tax and tell some of these guys that are some of these billionaires that are worth, 10, 20, 30, 50, 60, 100 billion, that, sorry guys, you got to pay some more taxes to make up for this. And hey, it is what it is. I'm totally fine with it. Because in the long run, you're going to balance the inequalities there in the disparity in wealth. You're going to make it easier for the poor and the middle class to start to, kind of get back going again. And, and hey, look, I mean, say you're an entrepreneur, and we have dozens of examples, but say you started a company and you did really well and you made yourself $50 billion. Well, it was the country that enabled you to do that. It was the country that gave you the opportunity to start the business and stay out of your way and basically let you grow that business and make all that money and make you rich and everything else. And that's great. Well, this is a time of, we've got problems, we've got issues, we've got soaring national debt, we've got a lot of economic issues, and the country needs help. So I look at it in terms of like, hey, you should be happy to pay some additional tax to give back to the country that so enabled you to achieve the success and riches that you enjoy. That's all. That's my take on it. But that's it. But basically, you're going to have to plug that gap somewhere. Now, but what I fear in stuff like this is, what is your definition of rich? Okay. For example, Barack Obama's definition of rich was anybody who made $250,000 a year, which is to me, it's an absolute joke because a lot of that depends on where you live. Like if you live in Boston or New York, or if you live in Connecticut, or if I mean, hey, even in parts of PA where I live, if you live in certain areas, live out in California, whatever, if you make $250,000 a year, what's that doing for you? Maybe okay in certain parts, but in a lot of places, not so much. So again, it's all relative. Basically, it's all relative. Yeah, if you're down in the Carolinas and Georgia and Arkansas, Kentucky, if you're in 40 different states and you're making 250 a year, you're probably living a great life. You're probably living an awesome life. But I'm just saying it's not so everywhere. It's not so everywhere. So I really think that depends. Like again, what do I know? But for my 2 cents, I would basically say like, hey, if you're making $1 million or more a year, then that's probably where you would start. You would basically say, okay, if you're making $1 million or more a year, you need to start paying a little bit more in taxes. That's all. So again, I just thought this was interesting because this was the first time that this basically had, some people had suggested this, but this was the first time that Trump had actually chimed in on this. And I think this will be really interesting to see how this develops over the next couple of months. And if and not even the next couple of months, I would say the next month, the next 30 days, I would say, we'll have to wait to see kind of what happens here with this, but it will be interesting. It will be interesting to watch. That's for sure. Because if Congress is going to deliver on a lot of these tax hikes, or these not tax hikes, if they're going to deliver on a lot of these tax cuts, they're going to have to find a way to plug that hole. So, okay. Now let's get into the tariff thing. Obviously, huge news this week. This is one of the biggest stories of the week. Trump unveils United Kingdom trade deal, first since reciprocal tariffs pause. So President Donald Trump unveiled a trade agreement with the United Kingdom. The deal with the UK is the first by the United States with a country whose imports were subject to new tariffs imposed by Trump. Many specifics about the agreement were not immediately clear, and nothing was signed during the Oval Office event. That's nonsense. We did get a lot of the specifics. Basically, what's going to happen here? So a fact sheet. So wait a minute. They just said many of the specifics weren't known, but the White House provided them with a fact sheet. So gotta love it, man. Keep in place a 10% blanket U.S. tariff on UK imports. So we're getting where we were getting zero before. Zero, everybody. We're getting zero before, and now we're getting 10%. Adjust tariffs on UK autos so that the first 100,000 vehicles imported from UK car manufacturers each year are subject to a 10% rate, and any additional vehicles face a 25% rate. Create a $5 billion opportunity for new exports for U.S. farmers, ranchers, and producers, including more than $700 million in ethanol exports and $250 million in American beef and other agricultural products. Commit both countries to working together to enhance industrial and agricultural market access. Close loopholes and increase U.S. firms' competitiveness in the UK's procurement market. Streamline customs procedures for U.S. exports. Establish commitments on intellectual property, labor, and environment. Secure the supply chain of U.S. aerospace manufacturers through preferred access to high-quality UK aerospace components. Create a secure supply chain for pharmaceutical products. Require the U.S. to negotiate an alternative arrangement to the Section 232 tariffs on steel and aluminum. That includes creating a new trading union for steel and aluminum. So basically, and we got the UK to reduce their tariffs from 5%, I think, down to 1.8%. So we went from 0 to 10, and we got the UK to come down from 5 to 1.8%. I would say that is an incredible deal. That is an incredible deal for us, and that is just the first. That is the first of many to come. And this is so, but it's amazing. They unveil this deal. It is a phenomenal deal for our country. It is a great deal for our country. It'll be a good deal for the UK too. It really will. But this is a great deal for us. And again, the media is just like, yeah, okay. But again, and this gets back to the frustration with the Fed. You begin to see how this is rolling now. This is just the first deal. There's going to be 100 more of these where this one comes from coming in over the next few months. And we're going to get to a point, it's going to take another month or two, but we will get to the point where literally this will become boring, because every day it'll be like, okay, we signed 10 new trade deals with these 10 countries, and we signed 5 more with these countries, and we signed 15 more with these countries. And it'll go like that for a month or so, where until we get to, like I said, 120 new trade deals. But to give the other perspective here, so why the Bank of England governor thinks uncertainty is here to stay despite a trade deal. So Bank of England governor Andrew Bailey told CNBC on Thursday that the UK was heading for more economic uncertainty despite striking a trade deal with the US. The UK-US trade agreement is very welcome, but the UK is a very open economy, Bailey says. The central bank chief said he was not surprised the BOE voted only narrowly to cut rates on Thursday, as there were risks on both sides of the outlook. So Bank of England Governor Andrew Bailey told CNBC on Thursday that the UK was heading for more economic uncertainty, despite the country being the first to strike a trade agreement with the US. The tariff and trade situation has injected more uncertainty into the situation. There's more uncertainty now than there was in the past. So what was their first inclination? We're going to have, since there's a lot of uncertainty and we're not quite sure what's going to happen, we're going to lower rates to help our economy out. Really? It's like magic. Oh my goodness. So, and then basically Trump goes on to say that 10% is the floor for tariffs. Some will be much higher. So Donald Trump said that 10% will be the floor for his tariffs on imports from other countries that seek trade agreements with the United States. Some will be much higher because they have massive trade surpluses, and in many cases, they didn't treat us right, Trump told reporters at the White House. Trump's comments came as he discussed a new trade agreement with the United Kingdom. So that again, this is very telling. This is very interesting. So we see the UK deal, the first deal, our tariffs stay at 10%. They go from 0 to 10. And basically Trump is saying that 10% is going to be the minimum. But for other countries, maybe Canada, maybe Mexico, maybe the European Union, definitely China, that those tariffs are going to be way higher than 10% until that trade imbalance begins to correct itself. Again, I love it. I love it. I think this has been so long overdue, and I need to say it again. I've said it a million times. I'm going to keep saying it. There is no such thing as free trade. We have not had free trade. There never has been free trade. Stop letting people, don't let anybody tell you free trade. I've been saying this since I was in college and first started studying this stuff 30 years ago. And I basically was like, this is ridiculous. Like, there's no such thing as free trade. I would get in arguments with my teachers in college about this notion of free trade. And I would say, wait a minute, if all these other countries are hitting the US with tariffs and we don't hit them with anything, how is that free trade? He's like, oh, well, because it's what the US believes, and the US believes in free trade. I'm like, no. That is all these countries around the world taking total and complete advantage of us, and us just sitting there taking it and doing nothing. I said, that's not free trade. That is being played for a fool. That is being chumps. That is letting all your jobs, your middle class, middle income manufacturing jobs getting sucked out the window through things like NAFTA. That's what that is. So So sorry, I had to rant on that. The Trump administration is set to end Biden's U.S. chip export restrictions. So the Trump administration on Wednesday prepared to rescind U.S. chip export restrictions known as the AI diffusion rule. The artificial intelligence semiconductor restrictions were scheduled to take effect on May 15th. Chip makers, including NVIDIA and AMD, have been against the tiered restrictions. So the Trump administration on Wednesday prepared to rescind U.S. chip export restrictions known as the AI diffusion rule, effectively stopping a set of artificial intelligence semiconductor limits from taking effect next week. A Department of Commerce spokesperson confirmed the plan to CNBC after Bloomberg reported on it earlier. NVIDIA shares climbed Wednesday in reaction to the news. The company has been vocal in its stance that restricting chip exports limits U.S. leadership in advanced technology. We welcome the administration's leadership and new direction on AI policy. A NVIDIA NVIDIA spokesperson said in a statement, with the AI diffusion rule revoked, Americans will have a once-in-a-generation opportunity to lead the next industrial revolution and create high-paying U.S. jobs, build new U.S. supplied infrastructure, and alleviate the trade deficit. The rule, which was proposed in the last days of the Biden administration, organizes countries into 3 different tiers, all of which have different restrictions on whether advanced AI chips, such as those made by NVIDIA, Advanced Micro Devices, and Intel, can be shipped to the country without a license. The chip restrictions were scheduled to take effect on May 15th. The Biden rule is overly complex, overly bureaucratic, and would stymie American innovation. A Department of Commerce spokesman said in a statement, "We will be replacing it with a much simpler rule that unleashes American innovation and assures American AI dominance." Chip makers, including NVIDIA and AMD, have been against tiered restrictions. All right, so that'll be interesting. But again, I think that hopefully will be a good thing long term. And then here was a very, very interesting article that I think everybody should pay big time attention to. So obviously been a lot of attention on the Panama Canal. Obviously, the United States built the Panama Canal, but then Jimmy Carter, in his infinite wisdom, basically gave the canal away to Panama for $1, but basically, signed an agreement with them that basically a treaty that said that as long as they do a number of certain things and abide by it, that everything will be cool. But if they did things to break the treaty, i.e., turn over basically control of the Panama Canal to the Chinese, which they've done, that would be breaking the treaty. So in which case the U.S. could go in and take it back, and that's what has basically been transpiring. So why the Panama Canal is a big long-term prize in Trump's global trade war. So President Trump's tariffs on China have led to a sharp decrease in manufacturing orders and freight vessel sailings from China. And with 75% of its traffic linked to the U.S., that's a headwind for the Panama Canal. Any recession worldwide or in the United States will impact somehow the Panama Canal. Boris Moreno, Vice President of Operations for the Panama Canal Authority, tells CNBC that's for sure. But President Trump's aggressive comments this year about U.S. reasserted control over a canal the U.S. says has ceded too much power to China reflects interest in a trade gateway where business has been booming. The Panama Canal has spent the past few years battling extreme weather with the El Nino phenomenon and severe drought leading to a water level crisis. Now it's President Trump's trade war that is threatening the global trade gateway, a critical passage for U.S. East Coast bound ocean freight container traffic. The Panama Canal is facing a potential business slump as a result of Trump's China tariffs and a rapid decline in manufactured goods being ordered by U.S. shippers. 40% of all U.S. container traffic travels through the Panama Canal every year, and in all, $270 billion in cargo annually. The U.S. and China are the top users of the Panama Canal, and its role in global shipping has increased in recent years due to the disruption of global supply chains. The Panama Canal's authorities' revenue hit $3.3 billion last year despite drought conditions, and revenue has increased every year since 2017. The trade war uncertainty and Trump's 145% tariff on China goods, which will start to hit goods arriving from China to U.S. ports on May 27th, based on the 4 to 6 weeks it takes for ocean freight to reach the U.S. from Asia, has already resulted in a massive pause on U.S. imports bound from China. According to data from supply chain intelligence firm Project 44, there has been a 300% increase in blank sailings, canceled freight vessels from China to the United States since Trump's so-called Liberation Day tariffs announcement on April 2nd. West Coast ports in the U.S. are already being hit, and the impact on East Coast ports is expected to increase with the pullback in vessels, a result of the decrease in manufacturing orders for Chinese factories. Less products manufactured translates into less shipping containers for ocean carriers. For the Asia to North American East Coast trade route, Sea Intelligence has recorded a cumulative blanketed capacity of 261,822 20-foot equivalent units, TEUs, over the last 6 weeks. This decrease in containers and vessels can impact Panama Canal revenue. The Panama Canal makes its money off of the number of vessel transits and containers moving through the waterway. But hold on, I want to get to the point here. I think that Panama over the last 5 years has inched closer and closer to China and away from the United States. Federal Maritime Commissioner Luis Solo said in an interview with CNBC earlier this year, "I've seen China and Brazil take away 20 billion with direct contracts. We definitely need to at least have a game there." Vicarte Vasquez, administrator for the Panama Canal Authority, tells CNBC that with the U.S. being the world's largest economy, it is reviewing Trump's concerns. Whatever is said in Washington has repercussions overall, said Vasquez. We try to stay cool, calm, and collected. He added, it is not true that we are run by the Chinese. Oh, sorry, I got something in my throat there. Yeah, this guy is so full of crap. It's unbelievable. Yeah, so basically this fight, this fight is not over with the Panama Canal. This fight is going to be big, because obviously we cannot, as a country, the United States cannot allow China to basically take over the Panama Canal. That just cannot happen. And if that means, I would say it's big enough that if it means going to war with China over the canal, that may have to be so. But the Panama Canal is a huge thing. And it has to be something that is controlled by the United States. The United States, we have to take back control of the Panama Canal and make sure, because again, if China controls that they could put a massive hurting on us by not allowing ships to get through there. Our ships going out, other ships coming into us. So it's a huge thing. So I just wanted to point this out, because I want people to understand how big of a deal the Panama Canal is, and why shouldn't we control it? We built it. What is it? 36,000 Americans died down there building that thing. 36,000 or 38,000, something like that. It's a crazy number of people, Americans, died down there building the Panama Canal, which is unreal. I mean, you think 58,000 Americans died in Vietnam, and 38,000 died building the Panama Canal. I mean, it's crazy to think about the number of people that died building it. And, why, Jimmy Carter, one of the dumbest moves ever, giving it away for literally $1. It's just unreal. So, all right. So the U.S. trade deficit, it hits record in March on pre-tariff imports spike. So imports grew by 4.4% to a record high of $419 billion as businesses bolstered their purchases before the government announced further tariffs. So here's kind of the dichotomy of what they talked about in the last article. And that was that, these ports are already starting to see these slowdowns, but yet we've got this U.S. trade deficit news right here that's basically saying we're seeing these pre-tariff imports spike. And I saw on social media, I mean, you literally have videos being posted up by different people showing the activity at some of these ports out in California. And it's fine. It's fine. It's bustling. It's booming. Now, that's not to say that things may not slow down over the next few months, but it's not happening right this moment. And any reports to the contrary are disingenuous. I think basically, everything is fine for the moment. We're actually seeing this if you want to call it the pre-tariff spike, but we're seeing this go on at the moment, and then we'll see what happens over the next 6 months. But the U.S. trade deficit widened to a record high in March as companies accelerated their imports ahead of U.S. tariffs taking effect. The Bureau of Economic Analysis data released on May 6th shows that the international trade deficit, a measure of when a country's imports exceed its exports, reached an all-time high of $140.5 billion. This is up by 14% from a revised $123.2 billion in February. The monthly international trade deficit includes both goods and services. Market watchers had anticipated a trade shortfall of $137 billion. Imports increased by 4.4% to a record high of $419 billion as businesses bolstered their purchases from abroad before the government made further tariff announcements. Companies purchased a greater amount of pharmaceutical products, finished metal shapes, passenger cars, and computer accessories. All right, and we're not going to go. Like I said, I just wanted to make the point that we did have imports grew by 4.4% to a record $419 billion, And we're basically seeing this pre-tariff import strike, if you will, right now at the moment. Okay, it's good, fine. All right, now before we do, I want to get in on this conversation on China. I've got a bunch of articles here, and I want to kind of explain the China threat, and I want to explain what's going on in the Chinese economy at the moment because it's a mess. But well, I'll tell you what, we're at the 1 hour mark. So before it said, because this is going to take me probably about 15 or 20 minutes to go through all this China, because it's about 6 articles that I want to go through here on the China thing. But let's take a pause for a second, because usually at this time in the show, what I like to do is I like to go over what economic indicators are coming out next week. I like to give you guys a little bit of bank news, and I like to tell you guys about the episodes that I had coming out this week, or I should say the episodes that I put out this week. So what economic indicators do we have coming up this week? So on Monday, May 12th, we have the federal budget balance. On Tuesday, May 13th, we have core CPI. We get the CPI for April. We get the API weekly crude oil stock. On Wednesday, May 14th, we get the OPEC monthly report. We get the FOMC member daily speaks at 5:40. On Thursday, May 15th, we get continuing jobless claims, initial jobless claims, core PPI, core retail sales, PPI, Philadelphia Fed manufacturing index, business inventories. And then on Friday, May 16th, we get building permits, housing starts, Michigan consumer sentiment, and the U.S. Baker Hughes oil rig count. So we got a lot of inflation news with obviously CPI, PPI coming out. We got retail sales. We got the Philadelphia Fed manufacturers index, and then we got continuing jobless claims and initial jobless claims. So a lot of really good economic data coming out this week that I will be sure to report on. So, okay. Now let's take a look at what were the 5 episodes that I had come out this week. So on Monday, I had episode 377 came out. So can faster federal payments increase demand for real-time banking? So this episode examined a recent blog post from PCBB titled Faster Federal Payments Mean Rising Demand for Real-Time Banking. So a recent shift in government payments could change the direction of bank strategy. Should banks focus more on payment channels and products like P2P, in other words, peer-to-peer, and FedNow? So very interesting question. So basically, you had this change in the government, in the type of payments that the government was doing. They wanted to make payments faster. So they were basically doing, a lot more what's called ACH, direct payments. So that basically led to the question of, would this have a ripple effect? And basically, would this force banks to then really take a look at what their strategy is with payment channels currently, and maybe they should invest in some further technology. Like, in other words, when we say peer-to-peer payments, what we're really talking about is like Venmo. We're talking about Zelle. We're talking about Cash App. So those are P2P payment platforms. I send money to you, you send money back to me, and it happens instantaneously. So that's what they're talking about there. And basically, FedNow would obviously make payments a lot faster. So that's just a question there in that episode. So again, I think it's a very interesting conversation and a very timely one, if you will, in the banking business. So episode 378 on Tuesday, 4 principles executives should use when making capital decisions. So this episode examined an article from Bank Director titled "The Cost of Flawed Capital Decisions." So banks use various metrics to evaluate a transaction. Some of these can include IRR, TBV, and EPS. So do these metrics tell the whole story, though? The authors of this article, they lay out 4 foundational principles that bank executives should use when allocating capital. How banks utilize capital is critical to the overall financial performance of that bank. Bad decisions can be costly. Yes, I thought this was a great example of looking at different metrics, understanding that those metrics, they tell you a lot, but there's also a lot that they don't tell you. And you have to kind of read between the lines, so to speak, and how, making those capital decisions are critical for any bank out there. And it gets very difficult. It gets very difficult. It's very easy to play Monday morning quarterback when you're in the heat of the moment and the pressure's on. can be a different story. So again, I thought that was an interesting episode. So Wednesday, I did episode 379, why banks do not embrace SBA lending. This episode examines an article from Bank Director titled Embracing SBA Lending in Difficult Times. So this article espouses the opportunity that SBA lending can provide to a bank. The article also provides 5 reasons why banks hesitate to provide SBA lending. So understanding why a bank would not want to provide SBA lending is perhaps more important than recognizing the opportunity. So that article was basically, it had the pom poms out. It was basically like, oh wow, SBA is such a great opportunity. Every bank should jump into SBA and want to do that, right? Nah, no, not really. One of the reasons why I love this episode and why I wanted to do this was because I actually had established and ran an SBA department in a previous life at one of the prior banks I had worked for. And I learned, in doing so, I learned a lot. Like I had done SBA loans for a while before that, but I had never actually kind of set the entire process up, managed that process, managed all the loans that were going through the queue, if you will. And it basically you learn an awful lot about why. And then obviously, if a loan goes bad, you have to deal with it. You have to work it out. You have to figure out what the deal is. And so the SBA is not all it's cracked up to be. And I really wanted to focus on those 5 reasons why banks hesitate to get into SBA lending. Some of them are classic. Some of them are well known. Some of them are really not what you would think unless you've actually done it and been through it. You wouldn't really think about it that way, or maybe have that type of perspective. So again, I thought that was I thought that was an interesting article of looking at from the other lens, as opposed to, instead of looking at all the opportunity, looking at from the other point of view and basically saying, why would banks not want to do this? So again, I thought that was a fun episode. I actually liked that episode a lot. And then on Thursday, I did episode 380. How does your bank differentiate itself by becoming a niche player? So this episode examines an article from Bank Director titled Finding Your Lane. There are many possible opportunities out there for banks to develop a niche. They could focus on deposits, cash management, and payment channels, or various types of lending. The important thing is for banks to develop expertise in the area they wish to target. Furthermore, banks must be careful not to develop too large a concentration in one industry. So yes, I think I found this episode to be a good one and a very interesting one, because most consumers look at banks out there and they see a bank, and to them, just a bank is a bank is a bank. They look at every bank is exactly the same, when that is absolutely not the case. Many banks out there have niches. They have things they like to do. A lot of, you would think that, oh, well, every bank makes real estate loans. And yes, they do, but they don't do all types of real estate. Some banks just do residential real estate. Some banks are much bigger on commercial. Some banks do construction lending. Other banks do not. Some banks, they like maybe lending on apartments and industrial, but they don't want to touch office. They don't want to touch retail. They don't, some banks love like smaller mixed use properties. So some banks like doing smaller deals as opposed to really big ones. There's all different kinds of flavors out there. And that was really the point of the article, that, hey, find a niche. That's how you're going to do really well in this business, is find a niche. So I loved it. I thought it was a really good, interesting episode. And then finally, I capped off the week yesterday on Friday with episode 381, which was part 19 in the crypto series. And this was basically an update on crypto regulation, and then looking at, what are SoFi, Morgan Stanley, and a bunch of other companies doing right now. It's really interesting. I have so much information in that crypto space right now that I had a lot of stuff to put in there. But in this episode, we basically reviewed upcoming crypto regulation. We looked at the Stable Act and the Genius Act. Have more information on the Genius Act, and that didn't go very far in Congress. We'll talk about that one in a few minutes toward the end. The Treasury sees stablecoins having a value of true $1 trillion in the future. SoFi is bringing back crypto investing. Morgan Stanley is adding crypto trading to their E-Trade platform. The FDIC, the Fed, and the SEC are permitting banks to engage in crypto-related activities. and crypto firms are looking to get bank charters. So there's a tremendous amount of stuff happening in the crypto sphere right now. Like I said, I tried to put that episode is a little bit longer at about 21 minutes or so, but there was so much great information in there. Go check that out when you have a minute. I think you'll love that episode. There's a lot of I touch on a lot of key things, and I would just note that for this week coming up, I'm going to have a couple. I'm doing kind of a continuation of that crypto episode. I'm going to do this week. I'm going to have a crypto series episode where I get more in depth on that Treasury report on stablecoins. We're going to really, because there was a lot of really interesting stuff in there, but I couldn't cover it in that episode. It really needed its own episode to give it enough time to go through all the different charts and graphs and things that were in that report. So I'll cover that this week. I'm also going to cover the report of what's called the TBAC, which is basically an internal board within the Treasury. They put out basically a quarterly report to the Secretary of the Treasury on just everything that's going on in the Treasury. And normally I don't pay much attention to those reports, but there's so much going on at the Treasury, and this is such a massive year for the Treasury that I figured, hey, why not check it out? Why not see what is going on with that? So I'll be kind of covering those two things in a couple of the episodes that I put out this week. So, okay. All right, guys, hang on for a second. I need to steal some water. Okay. All right, let me hit some banking news here for a couple of minutes with you guys. So, the Farm Credit Administration, their report on the FCS performance. So the Farm Credit Administration released an update on the financial condition and performance of the farm credit system as of March 31st. The FCS has $453 billion in debt outstanding, a 28% increase since year-end 2021. Wholesale inventories increased in March. Mortgage rates remain steady. The rate for the 30-year fixed rate mortgage was at 6.76% this week, the same as last week, according to Freddie Mac. The 15-year FRM average was 5.89%, down from last week's 5.92%. The OCC's hood, reducing regulatory burden is a priority. So acting controller of the currency, Rodney Hood, said one of his main priorities is reducing regulatory burden to ensure that financial institutions can thrive and innovate. The OCC rescinds the rule on bank mergers. Excellent. The OCC rescinded its 2024 final rule on regulations for business combinations involving national banks and federal savings associations. So the new interim final rule that rescinds the rule also restores the streamlined application and expedited review to the OCC's procedures for evaluating applications under the Bank Merger Act as advocated by the ICBA. Which is fantastic. So again, just speeding up the merger process. If it's not broke, don't fix it, as they say. Okay, Senate votes down effort to advance the stablecoin bill. I'm gonna get back to that in just a minute. Mortgage applications increased for the week. So mortgage applications for the week ended May 2nd increased 11% from 1 week earlier. Consumer credit increased in March, the first quarter. So consumer credit increased 2.4% in March after decreasing 0.2% in February. The Federal Reserve reported quarterly data. Consumer credit increased at a seasonally adjusted annual rate of 1.5% during the first quarter. Revolving credit increased at an annual rate of 2.3%, while non-revolving credit increased at an annual rate of 1.2%. OCC clarifies crypto asset guidance. So the OCC clarified permissible bank activities related to crypto asset custody and execution services. So in a new interpretive letter, the OCC said that banks may buy and sell assets held in custody at the customer's direction, are permitted to outsource to third parties bank permissible crypto asset activities, including custody and execution services, subject to appropriate third-party risk management practices, and they must conduct crypto asset custody activities, including via a sub-custodian in a safe and sound manner and in compliance with applicable law. So the OCC in March issued guidance for crypto asset activities that rescinded previous guidance that said banks must demonstrate to the satisfaction of its supervisory office that they could engage in permissible crypto asset activities in a safe and sound manner. So this is obviously a big step in letting banks be able to get into crypto. As basically that's how you have to read that. And I talked about that a lot in the crypto episode that I put out on Friday, but just thought I'd give you guys a little bit of update there now. The CFPB deprioritizing buy now, pay later enforcement action. So the Consumer Financial Protection Bureau announced that it will not prioritize enforcement actions related to buy now, pay later. So the CFPB said in an announcement applies to enforcement actions taken on the basis of buy now, pay later, interpretive rule the agency released in May of 2024. In its announcement, the CFPB said it is contemplating rescinding the buy now, pay later rule. So the rule requires buy now, payday lenders to provide consumers some key legal protections that apply to conventional credit cards, including a right to dispute charges, demand refunds for returned products, and receive billing statements. So I kind of have mixed feelings on this one. I actually did kind of like some of the things that the CFPB was doing there, but they may not have necessarily been going about it in the right way. So again, what I think is that this is probably the right action for the moment. Let's maybe get rid of that. And then what I think will happen is I think they will come back and revisit this. And I think they'll make some tweaks to it and propose something new in the not too distant future. So that's just, again, I don't know that. I don't have any inside information on that. I'm just, being, just trying to think about how that may play out over time, but we'll see. Senate panel advances Bowman nomination. So after the Senate Banking Committee advanced the nomination of Michelle Mickey Bowman to be the Federal Reserve's Vice Chair for Supervision, ICBA urged the full Senate to approve Bowman for the role. Yes, absolutely. And pulling for Mickey Bowman there, hope that goes through. Services sector index increased in April. So economic activity in the services sector increased for the 10th straight month in April. OCC seeks community bank input on digital solutions. So the OCC issued a request for information on the challenges faced by community banks in the implementation of digital banking solutions. IRS announces HSA amounts for 2026. So the IRS published contribution limits and high deductible health plan requirements for 2026. In 2026, the annual deduction limit is $4,400 for individuals with self-only coverage under a high deductible health plan and $8,750 for individuals with family coverage. So interesting. Okay. President's fiscal year 26 budget proposes to cut $291 million from the CDIF fund. So President Donald Trump's fiscal year 26 budget proposal to Congress seeks to cut $291 million from the Community Development Financial Institutions Fund. The budget proposes eliminating CDFI fund discretionary awards, saying the CDFI industry has matured beyond the need for seed money and should at this point be financially self-sustaining. So yes, that fight will continue. And I will try to bring you guys more information on that as we have it. ICBA encourages HUD to revise disparate income rules. So the ICBA asks the Department of HUD and Housing Development to revise its 23 disparate impact rule under the Fair Housing Act. In a letter to HUD, ICBA said the rule should align with the Supreme Court's 2015 decision in Texas Department of Housing and Community Affairs versus Inclusive Communities Project, Inc., and President Donald Trump's April 2025 executive order restoring equality of opportunity and meritocracy. So the ICBA recommended incorporating a robust causality requirement, recognizing profit-driven decisions as legitimate, limiting liability to artificial, arbitrary, and unnecessary policies, prioritizing injunctive relief over punitive damages, and clarifying the 2-year statute of limitations to prevent extended liability. So under HUD's rule, lenders could be held liable for neutral policies or practice that have a disparate impact on certain classes of borrowers without a requirement for plaintiffs to prove that the policy or practice caused the disparity. So yeah, I hated that disparate impact rule when it came about in 2013. It was bad. It was just a horrible rule, but it came out. Hopefully they'll do something with it. So ICBA also, OCC should pave the way for successful bank fintech partnerships. So ICBA told the OCC that as banks and fintechs increasingly collaborate, it is essential that regulators adopt policies and recognize the benefits of these partnerships and address emerging risks in a thoughtful, proportionate manner. So, okay, we'll keep an eye on that. 1071 rule remains on hold for community banks amid the CFPB review. So the Consumer Financial Protection Bureau's 1071 small business rule and its implementation deadlines remain on hold for ICBA community banks amid ongoing litigation and a bureau review of the rule. So yeah, as I reported last week, there's still a lot of court stuff going on with this, a lot of things happening. We'll just have to be patient and wait to see how this plays out. But there were kind of three big things at the start of the year that I was looking at. One was the beneficial ownership information, which has gotten completely shut down. So happy about it. The 1033 open banking rule that was being pushed by the CFPB, that's been kind of put on the back burner with all the things going on at the CFPB, but it's still there. It hasn't been killed yet, so we have to keep an eye on that. But then the third thing was this 1071 rule, which basically was it was the collection of a tremendous amount of data on small business loans and small business lending. So in other words, if you were coming in to get $100,000 line of credit for your bank, for your business, the bank was going to have to collect all this demographic information on you and your business, you personally on your business, and then send it out over to the government. Very invasive, very over the top, and again, not a great thing, not something I was an advocate for. I wanted this taken down. So hopefully it does. We'll see what happens. CFPB asked court to stop medical debt rule. So the Consumer Financial Protection Bureau joined other groups in asking a federal court to scrap a regulation barring consumer credit reports from including medical debt. In a motion submitted in a Texas federal court, the CFPB asked a judge to strike down the rule, saying it had exceeded its legal authority. So the CFPB last year proposed to amend the Fair Credit Reporting Act regulations by prohibiting creditors from using medical financial information and by limiting the circumstances under which consumer reporting agencies are permitted to provide medical debt information to creditors. So yeah, I think part of the issue there, and I've reported on this in past episodes, is that your credit report, right? Well, there's a lot of discussion about how can you get your credit score up, or how can the government help or help consumers to get the overall scores up on the credit reports to make it easier, obviously, to qualify for lending. But the problem is they've been scraping things off. Like first it started with judgments and tax liens and taking all that off. Now they've gone to medical bills. Again, part of the CFPB thing with the buy now pay later was they wanted to start reporting the buy now pay later on people's credit reports. That could be a good thing and it could be a bad thing. It could be a good thing because it might help you establish repayment history, which is good for your credit report. Could be a bad thing because if it shows you with too much credit, it could hurt your credit report. Or if you've got delinquent payments, it could certainly hurt your credit report. So it's kind of a double-edged sword there in that regard. But this rule again. But it gets back to this premise of if you're a bank and you're trying to underwrite these things, it's you don't know what you don't know. And the problem is, you might get a credit report on somebody that you think looks fantastic. Oh, they've got a 750 credit score. This is wonderful. There's no delinquent debt. There's nothing outstanding. Everything looks great. But then here you come to find out that, oh, well, they got delinquent taxes. They got all these past due medical bills that didn't show up. And if we had known that, we may not have made them the loan. And what happens is it also forces banks to go out, like, take a company like LexisNexis, you might have to go to LexisNexis and buy a separate report from LexisNexis to fill in the blank, so to speak, or get that information that you weren't getting from the credit report. Thus, it's a negative because now the bank is going to say, okay, instead of just paying $30 for a credit report, we had to pay $60 to buy 2 reports because they took all the other stuff that used to be on the credit report. They took it off, and now we had to go to another company to get it. So again, it's just not a great strategy overall. I think it's one of these things. It's like you need to go back, to the drawing board there. Okay, and then following first acquisition in Montana, ICBA continues call for credit union tax. So, with the latest interstate acquisition of a tax-paying community bank by a tax-exempt credit unions extending into Montana, ICBA said it is time for the increasing criticism of credit union tax and regulatory exemptions to finally result in policymaker action. So, basically, we had another credit union deal where a credit union was buying a bank. ICBA got very upset about that and basically said, no, we can't have that. And we got to put a stop to this. And we have to start getting a tax on credit unions. So it's like I said, so we'll see what happens with that. So, okay, let's get back to some articles. I really want to get into this China thing here. I want to run through a series of articles here with you guys on what's happening with China. So first up, first round of Chinese negotiations actually happened today. It happened this weekend. So it started basically yesterday with Trump floats cutting the China tariffs to 80% from 145%. The announcement comes as the White House officials are set to meet with high-level Chinese authorities. So, so basically this was President Trump on Friday signaled that he may cut tariffs on China from 145 to 80% ahead of a meeting between the White House and top Chinese regime officials over the weekend. And now I'm going to go right to this. So again, this is a master negotiator time here. Okay, this is negotiation 101. If you want to get something, first you give something. Okay, so this is why he jacked the tariffs up so that he could back off a little bit and basically make it look like he was doing something. So again, this is this fantastic strategy here. I love it. Okay. Now, U.S. and China conclude the first round of trade talks. They will resume on Sunday. The first round of talks went on for more than 10 hours today. So negotiators from the United States and China have finished their first round of trade talks in Switzerland and scheduled a second for May 11th. Treasury Secretary Scott Bessent and U.S. Trade Representative Jamieson Greer began meetings in Geneva with a Chinese delegation of high-ranking officials led by Vice Premier He Lifeng. The two sides convened in an effort to negotiate a way out of their trade war, which has seen tariffs on goods from either nation reach more than 100%. The first round of talks went on for more than 10 hours and included a lunch break. So now, obviously, if you were paying attention today, you knew that what happened was, there was a story out that basically the talks had started, and within, I think, the first 20 minutes, the Chinese guys got up and walked out of the room. But then and they're so like, oh, the Chinese have walked out, whatever. But then they came back, and then of course it was reported that they said no, they were just taking a break or whatever. So I think there's probably a little bit of truth on both sides there. I think it started out. I think China probably came in, tried to bully maybe Scott Bessent and whoever else was there negotiating on behalf of the U.S. I think they tried to, blow them off the table, so to speak. And within the first 5 to 10 minutes, they realized that wasn't going to happen. And they started to hem and haw and pout and probably stormed out of the room. And which is fine. I love it because they lost. Okay. If you get up and storm out of the room, you lost. Okay. That's how negotiations work. And I'm sure they did do that. And I'm sure they made a phone call back home and somebody said, get your butt back in there and go work on this thing. So back then they went and they sat for 10 hours and worked through and maybe made some progress, maybe didn't. We don't know. We'll have to see. But this goes on to say basically, trade between the two nations, which are also the world's largest economies, topped more than $660 billion last year. And President Donald Trump suggested he was considering lowering the U.S. tariff on Chinese imports to 80% in the coming days. Hopes for a significant breakthrough appear dim as both sides have struggled to acknowledge who called for the talks to take place, with both publicly saying that the meeting was being held at the request of the other. Complicating the issue further are geopolitical considerations, such as Communist China's continued efforts to undermine U.S. interests abroad by providing diplomatic, economic, and military assistance to authoritarian powers like Iran, North Korea, and Russia. To that end, Chinese Communist Party General Secretary Xi Jinping was visiting Russian Premier Vladimir Putin in Moscow over the weekend, casting a shadow over hopes that economic talks could lead to a general thaw in relations between Washington and Beijing. Treasury Secretary Scott Bessent has said the issue of U.S. trade with China is a key national security issue and said it should be treated with the corollary seriousness. Economic security is national security, and President Donald Trump is leading the way both at home and abroad for a stronger, more prosperous America, Bessent said in a statement released ahead of the talks. And let me just see here. Yeah, so they've traded tariffs back and forth. My bet right now is that this doesn't really lead to anything right now this weekend. My bet is that this basically goes and not really much. I think they'll talk tomorrow, maybe another 6-8 hours. Do I think that a lot of progress will be made here? No. I think this was a first round, exactly what they called it here. I think this was just a first round. I think this was a feeling out, if you will. I think they're trying to gauge, how serious is the U.S., how far is the U.S. willing to take this? And my guess is Scott Bessent is basically saying to them, hey, we're willing to go all the way. We're willing to go all the way on this. So if you don't want to bend, we're going to break you. So that's just my guess on how this first round is going to play out here. So, and again, getting back to our Fed here. So what does China do? Oh, China lowers rates and makes bank lending easier in response to tariffs. So Beijing sticks to incremental steps in the first economic package since Trump's April moves. So what does China do? So China calls for this meeting with the U.S. because they need to look like they're doing something. But then what do? They do a series of actions to wait for it, help their economy. They lower rates. They ease, lending. They ease, regulations. They go out and they weaken the yuan. They do all this stuff to basically help their economy in this moment because they know they need it. And their central bank is like, oh yeah, okay, no problem. We need some help here. We're doing this. We're doing that. And again, it just adds to this frustration level of like, what is Jeremy Powell doing? Every other central bank around the world is reacting or doing something to try to help their country and help position their economy in a better place. And yet Powell continues to do nothing. But anyway, so Beijing sticks to incremental steps in the first economic package since Trump's April moves. So China's central bank will cut interest rates and inject liquidity into its financial system. The cut will release around $139 billion of liquidity into the financial system, allowing banks to lend more. Markets are reacting to the possibility of formal U.S. trade talks in Switzerland. So China's central bank said Wednesday that it would cut interest rates and inject more liquidity into the financial system, seeking to bolster the economy in response to trade tensions with Washington. The measures, Beijing's first concrete steps since Donald Trump ratcheted up tariffs on Chinese goods in April, continue the Chinese government's incremental approach to dealing with economic difficulties. They fell short of giving consumers a strong push to spend, an idea some economists have advocated. The government had touted Wednesday's new conference by policymakers as an announcement of a policy package to stabilize the market. The package turned out to consist mostly of expanded previous moves, including a further lowering of the ratio that determines how much banks have to hold in reserves. That ratio was lowered last September and will fall by an additional 0.5 percentage point on May 15th. Officials said the cut would release around 1 trillion yuan, equivalent to $139 billion of liquidity into the financial system and allow banks to lend more. The Hang Seng Index right here, you can see, basically Trump announces the tariffs, really took a shot down, but his bounce back there. The central bank also cut several interest rates that it had been trimming since last year, including the rate on 7-day reverse repurchase agreements, a key policy rate which is lowered by 0.1 percentage points. So basically, you're just seeing the Chinese economy reacting. Now, they are reacting. Why are they reacting? They're reacting because of these next two articles here. So U.S. tariffs may drive China's economy into a depression, experts say. So exports made up 1/3 of China's economic growth last year. So export numbers are hard for the regime to forge as they have to match other countries' imports. So we're going to get back to data. We're going to get into data in just a minute here. So Li, a garment exporter in southern China, said the United States' steep tariffs have dealt a devastating blow to his business. The business owner from Guangzhou province said his orders from the United States evaporated as the levies escalated. Li is not alone. Most Chinese exporters are in the same boat. On social media platforms in China, they discussed the problem. A few said they were immune from the impact the U.S. tariffs owing to their irreplaceable products. These exporters reported that U.S. orders formed the majority of their business and were the most lucrative. Without the American market, no other region, including Europe, can fill the void. Exports had been among the few bright spots during China's bumpy economic recovery since late 2022, when the regime ended its strict COVID-19 lockdown measures. Now it is being hit hard by tariffs. Beijing's official economic data show that China's economy has still been growing, albeit at a slower pace. Some experts dispute these figures. They say China's economy is already in recession, and U.S. tariffs may make things a lot worse. China's in a real problem period. Rod Martin, founder and CEO of Martin Capital, told the Epoch Times Beijing will have trouble backing down from its standoff with the United States, he said, because Chinese Communist Party leader Xi Jinping has clearly created this whole persona around being the leader who can stand up to America. Yes, I've talked about this before. Given the irreplaceable nature of the U.S. consumer market and China's export-driven economy, Martin said, Beijing will have to make a deal at some point, or this recession does turn into a depression. William Li, chief economist at the Milken Institute, an economic think tank based in California, said Xi will likely subsidize Chinese exporters at the cost of further increasing deficits of heavily indebted local governments. The Chinese regime can probably keep exporters afloat for about 6 months to a year if it doesn't resolve the trade war with the United States, Li projected. Okay, so there you have it. So they got, like I said, going back to this first round here, okay, like I said, this is just an opening salvo. Like I said, I don't think much will come of this, because what do we get in this article here? He's saying that he's got about 6 months to a year that they can kind of float this thing. If they, if they can't resolve the trade war, they've got about 6 to 12 months before basically things start to get real bad. And then, it says, obviously a grim outlook. China's manufacturing activity hit a 6-month low in April. In April, China's factory activity contracted the fastest in 2 years, according to the country's National Bureau of Statistics. From recession to depression, in early April, Goldman Sachs estimated that China could lose about 10 million to 20 million jobs due to tariffs. That has already started, according to videos online. After China's overcapacity distorted the global markets for so long, and the global markets began to say no, the domestic market won't be able to absorb the overproduction. Yes, China's exports to the world. You can see this great chart here. In 2019, it was 2.5 trillion, 2.6 trillion, 2021, 3.3 trillion, 3.5 trillion, 3.4 trillion, and then 2024, 3.6 trillion. So again, signs to watch, different things coming out there, but a great article on what's going on there. Now we go. China's 6 biggest banks report a 1 billion profit drop. So the loss of profit in the banking sector indicates an all-round economic slowdown, even a stall, an analyst said. So China's 6 largest banks have posted first quarter reports with a significant drop in both earnings and profits. Experts said the profit drop to China's banking industry indicates a stalling economy that is likely to continue to worsen as the effects of the tariff war between China and the United States kick in. The 6 Chinese major banks, which are all state-owned, Industrial and Commercial Bank of China, Agricultural Bank of China, Bank of China, China Construction Bank, Bank of Communications, and China Postal Savings Bank, released their first quarter data on April 29th. Taken together, their net profit attributable to parent companies fell by 7.3 billion won, or $1 billion, compared with the same period in 2024, a decrease of about 2%. Among them, Industrial and Commercial Bank of China, the world's largest lender by assets, saw a 4% net profit drop year over year. The Bank of China posted a 2.9% decrease from the year before. The 6 banks reported a total revenue of 912 billion won, 125 billion in the first quarter, a year-over-year decrease of 13.9 billion won, or $1.9 billion. ICBC is the only major Chinese bank with a single quarter revenue of more than 200 billion won, or 27.5 billion. although this is still represents a 3.2% decrease from the same period in 2024. So, but basically the point here being is that, China's banks are starting to take it on the chin. And when we go back to hold on. When we go back to this one of these earlier articles here, China lowers rates and makes bank lending easier in response to tariffs by pumping liquidity into the market. Again, a major reason why they did this is because they saw the losses in these banks. They saw these banks basically report that they lost $1 billion. So it was like, okay, we need to lower interest rates and pump some liquidity into the system because our banks are starting to take it on the chin. Now we get to the coup de grace, if you will. How bad is China's economy? The data needed to answer is vanishing. It's vanishing. So Beijing has stopped publishing hundreds of statistics, making it harder to know what's going on in the country. So they open negotiations. So again, you got to look at the chessboard here. They're opening negotiations. They're doing things to stimulate the economy. They're cutting rates. They're pumping money into the banks, but they're also cutting data. They're cutting away the data. They don't want the rest of the world to see the data because they don't want the rest of the world, especially us, the United States, they don't want us to know how bad things are getting. We don't have the luxury of doing that because we have to be transparent to, the U.S., to our citizens, and to the world. But China has stopped publishing hundreds of data points, including land sales, foreign investment, and unemployment figures. The missing data makes it harder to understand China's economy amid issues like debt and a troubled real estate market. Alternative data sources are being used to assess China's growth as the accuracy of official GDP figures is questioned. So not long ago, anyone could come through a wide range of official data from China. Then it started to disappear. So, and let's look at some of these charts here. National land sales by area. You can already see the land sales dropping, but then all of a sudden, earlier this year, the data stops. Or go down here, a number of people in urban areas who receive unemployment insurance benefits starting to increase upward here. And then, oh, wait, look, the data stopped. And then we're going to keep going down here. State of the economy, official GDP. Well, is it real? Is it not real? Well, we're not quite sure. And I got some more charts for you. National land sales by value. Again, you see the land sales start to drop off a cliff, and then wait a minute, the data stops. Now we go on to some other things here. So China's unemployment rate for ages 16 to 24. Spiking up to over 20%. Look at that. China's unemployment rate for ages 16 to 24 spiking up to over 20% here. And then, of course, they stop the data because they don't want us to see what's really going on there. And then we got a few more here. Chinese toll roads Chinese toll roads year-end debt balance. You can see this going up over $1 trillion. Data stops. New stock market investors in China, data stops. Number of cremated bodies in China, you see that really spiking up to over 6 million people. Data stops. Soy sauce production in China, data stops. So again, they're cutting a lot of, China's starting to cut a lot of this data because they don't want us to see, from a negotiation standpoint on tariffs, they don't want us to see how how badly they're basically taking it in on the chin over there. What I'm trying to paint the picture for everybody here is to see that China's economy is in real trouble, but politically, they cannot be seen as weak. Okay. Xi Jinping cannot be seen as weak. And that's what takes us to the next couple articles here that I want to show you real quick. So China ramped up fentanyl precursor production to target U.S., experts say. So under U.S. pressure, the regime banned fentanyl production in 2019, but Chinese companies simply shifted tactics and shipped precursors to Mexico. So basically, The Chinese regime began a secret project during U.S. President Donald Trump's first term to weaken the United States by scaling up production of fentanyl precursors and shipping them to Mexico and Canada for manufacturing and distribution across the border, according to an insider who has sources in Beijing's top political circle. The plan, which the Chinese regime had dubbed Project Zero, aims to make Americans addicted, according to Wan Hongbig, a dissident and jurist living in exile in Australia. His sources are close to the descendants of senior CCP officials. They asked to remain anonymous because of security concerns. Top CCP officials have continued to push fentanyl into the United States, Wan told the Epoch Times in a recent interview. Feared that the plan will leak out, contradicting Beijing's claims that it is being a responsible actor is one reason Beijing has chosen to go ahead head-to-head with Washington during the tariff war. So again, part of the trade war that people have to understand with Mexico and Canada has been to stop fentanyl from coming into the U.S. Fentanyl is killing over 100,000 people a year in the United States, and China is doing this on purpose. They're doing this on purpose. Like, we have to stop that. I mean, think about this. This would be an act of war. For if any other country came in, was basically like, oh yeah, we're selling drugs through Mexico or Canada into the U.S. and we're killing 100,000 plus U.S. citizens every year. That would be an act of war. And yet China has miraculously been able to get away with this. This week, Trump banned gain-of-function research in China and other countries. Why? Because the virus of unknown origin came out of China. And it was from gain-of-function research. We know this now. This is not debated anymore. This is fact. President Donald Trump on May 5th banned federal funding for gain-of-function research in some countries, including China, just weeks after his administration said the COVID-19 likely came from a Chinese laboratory that received U.S. funding. It's a big deal. Again. So, but why do I point this out? Why do I point this out? I point this out because I'm going to spend time over the next, month or so. I want to go through a series of books. This book right here, 5G Warfare. This is the world today. We went from 2G warfare to 3G warfare to 4G warfare to now we are in 5G. We're now in 5G warfare, and this was a book written by General Michael Flynn. So we're going to talk about that, and then we're going to talk about these two books here, Unrestricted Warfare, and basically War Without Rules. War Without Rules is basically just covering this. This is like the original, writing right here, translated from the original People's Liberation Army document, and this is kind of a book explaining this. But again, we are basically already at. If you understand 5G warfare, you will understand that we are basically already at war with China in a number of different arenas. And the trade war is just another aspect of that full-on 5G warfare. 5G warfare, it's not just kinetic warfare. It's economic warfare versus the trade. It's doing things like undermining. It's bribery. It's buying land in the United States. It's putting your assets in positions in academia to poison the students. It's doing a whole level of things that are going on. So the reason why I want to explain this is because the trade wars, the tariff wars, if you will, are just another part of this overall picture. And like I said, I want to spend some time over the next couple of months painting this picture so that people hopefully get just a better understanding of what this all is, because it's much more than just, again, the economic aspect of this is just one aspect of it. It's a multi-pronged approach, and it's warfare from many different angles. And once you understand that, you will understand, what China is doing and why they're carrying out a lot of these things. It's necessary to understand this, to understand the economic aspects of this. That's why that's the whole point of why we're talking about it. So, okay. Let's get into some other news here real quick before we wrap up. I just want to run through a couple of these other things real quick here. So, Trump administration restarts student loan collections for millions in default after years-long pause. So, the U.S. Department of Education will resume collecting on defaulted student loans on Monday. More than 5 million borrowers are currently in default, and that total could swell to roughly 10 million borrowers within a few months, according to the Trump administration. The federal government has extraordinary collection powers on its student loans, and it can seize borrowers' tax refunds, paychecks, and Social Security, retirement, and disability benefits. And then we go into another article here that says, crackdown on student loan defaulters to begin with benefit seizure, then wage garnishment. Federal collections have resumed after the pre-pandemic freeze. Beginning in June, the government will intercept defaulters' tax refunds and other payments. So the U.S. government will begin seizing federal benefits from 195,000 student loan defaulters in June, with wage garnishment notices set to reach 5.3 million borrowers later this summer. The Education Department announced on May 5th, marking the formal restart of involuntary collections after a years-long pause. The renewed enforcement effort begins with the Treasury Offset Program, which allows the federal government to intercept tax refunds, Social Security checks, and other federal payments to recover unpaid student debt. Borrowers affected by the program began receiving notices on May 5th, the department said. Starting today, approximately 195,000 defaulted student loan borrowers will begin receiving an official 30-day notice from the U.S. Department of Treasury notifying them that their federal benefits will be subjected to the Treasury Offset Program, the Education Department said in the May 5th announcement. So, I do have mixed feelings on this. On the one hand, yes, people have to repay their loan. People have to repay their loan. It's as simple as that. But I'm concerned that Republicans may be too overzealous in this action, and they may be going about this. They may be going too hard on this. Again, if somebody is having issues, I think you need to try to provide, resources for them, and i.e., different loan programs, maybe like hardship programs, different things out there to try to help them along. Again, the idea here is to make it so that they can get these debts repaid and get them paid off at some point in the future, not that they have these things hanging over their head forever and a day. So again, I do, like I said, I do worry that, they're going at this thing a little too hard, but we'll see what happens here over the next month. I thought this was interesting. So some crypto stuff here. So crypto regulation bill fails to advance in the Senate. So a first of its kind crypto bill failed to advance in the Senate after key Democrats withdrew. So let me just read this for a second here. So the Senate voted against advancing a federal supervisory framework for stablecoin, though a second vote could come as soon as next week, depending on the outcome of negotiations over differences on many key issues. The Guiding and Establishing National Innovation for U.S. Stablecoins, otherwise known as the Genius Act, failed to advance on a 48-49 vote. The bill needed 60 votes to advance. Community bankers concerned. So while progress was advanced in recent weeks on many areas of the bill, ahead of the vote and prior to the release of the bill's final language, ICBA again urged the Senate to ensure key community bank concerns are addressed in the Genius Act before any Senate vote. So obviously they're still fighting and arguing over that one, and we shall have to see how this comes out. Now, part of that fighting was about this. So Trump set to raise millions from crypto meme coin this month. So the Crypto and AI Innovators Dinner is a $1.5 million per plate. 1.5 million per plate. Wow, that's a dinner I'd like to be at. And features President Donald Trump and venture capitalist David Sachs. So the May 22nd gala at Trump National requires Trump meme coin token ownership to attend, with access awarded via a public blockchain leaderboard. A watchdog group warned that the contest enables anonymous donors, including possible foreign nations, to buy access to Trump while enriching his affiliates. President Donald Trump has two crypto-focused dinners on the calendar this month, one aimed at deep-pocketed political donors, the other at meme coin millionaires. Both are poised to help him rake in millions. The first event, a $1.5 million per plate fundraiser set for Monday, is among the priciest political fundraisers in recent memory. The second, on May 22nd, offers access to Trump's inner circle, not for cash, but for holders of the Trump token. Hosted by MAGA Inc., the Crypto and AI Innovators Dinner on May 5th features special guest David Sachs, who has been helping to rewrite the country's crypto and artificial intelligence rules. The committee receiving the funds, MAGA Inc., is a super PAC that supports Trump, but the president is constitutionally barred from running for a third term. It's unclear how the PAC plans to spend the millions of dollars it is raising this spring at a series of dinners. The crypto community has cheered Sachs' growing influence in Washington, crediting him and other Trump-allied appointees with a sweeping policy shift that's already delivered a spate of regulatory wins across multiple federal agencies in what many industry executives are describing as a 180 pivot from President Joe Biden. The second gala dinner will be held at Trump National, the president's private club in Washington, D.C. area later this month. The guest list will be decided by the blockchain-based contest run by the creators of the Trump meme token. Instead of cash, entry is based on how many tokens a user holds. With the top 220 promised dinner with Trump himself, the contest runs through May 12th. So 2 more days. So, hey, buy your Trump meme coins right now, everybody. Yeah, I gotta say, like, I am a little concerned about this. I can't say that I've been crazy about, Trump's family has really been pushing crypto. And, I reported on a story from Eric Trump last week where he was over in, I think, Dubai at some conference. And he was talking about crypto's the future and our banking system's antiquated and banks need to get on board with this. Otherwise they're going to fail and all this kind of stuff. And so, yeah, I do worry about this a little bit. I do have concerns with this. I can't say I'm crazy about this. This is the direction that they're choosing to go in. Again, personally, I don't mess with crypto. I don't want to mess with crypto. I think crypto is trouble. And I'm just not in favor of all that. So, but okay. Coinbase acquires crypto derivatives exchange Deribit for $2.9 billion. So that's a very interesting thing. So Coinbase agreed to acquire Dubai-based Deribit, a major crypto derivatives exchange, for $2.9 billion, the largest deal in the crypto industry to date. So very interesting. So I'll have more on that. Let's see here. A $1 billion tax bill is looming over Boston homeowners. The value of some Boston office buildings has tumbled by 50%, causing homeowners to pick up the tax burden. So Boston homeowners face rising tax bills due to declining commercial property values, shifting the tax burden. Office building values in Boston have dropped significantly, with vacancy rates rising and new commercial development at a near standstill. Mayor Wu seeks to shift the tax burden to commercial landlords facing opposition amid re-election challenges. Yeah, I don't think Wu's going to be around very long there at Boston. She seems to be doing a bang-up job. Not really. All right, this is one I'll have to talk a little bit more about. I might save this one for next week. So the terrifying way scammers clone your voice to defraud your family. AI has added a new layer of subterfuge to spoofing, extending its reach to worsening its effect on victims. So this is kind of a crazy one, and I'll have to get into that a little bit more next week. This one brought me some joy. Theranos founder Elizabeth Holmes loses bid to have appeal of fraud conviction reheard. Yeah, they should not. First of all, she got a light sentence. I think she got sentenced to like 11 years of prison. Yeah, she should have got a lot more than that. And she won't even do 11 years. So my guess is she'll probably be in there for like 6 years or whatever. But yeah, so I'm glad that got turned down. That gave me a little joy this week. So yeah. So okay. With that being said, guys, I'm going to wrap up now. First, we're going to do, as I try to do, our story of the week, and then we're going to do our quote of the week. So our story of the week here is actually the Bretton Woods Agreement and System. So the Bretton Woods Agreement was negotiated in July of 1944 by delegates from 44 countries at the United Nations Monetary and Financial Conference held in Bretton Woods, New Hampshire. Under the Bretton Woods system, gold was the basis for the US dollar and other currencies were pegged to the US dollar's value. The Bretton Woods system effectively came to the end in the early 1970s when President Richard Nixon announced that the US would no longer exchange gold for US currency, also known as the United Nations Monetary and Financial Conference. Attended by approximately 730 delegates representing 44 countries, with World War II was still raging in Europe and the Pacific. The conference's goals included creating an efficient foreign exchange system, preventing competitive devaluation of currencies, and promoting international economic growth and cooperation to accelerate recoveries for countries devastated by the conflict. The Bretton Woods system called for the US dollar to be pegged to the value of gold. Other currencies in the system were then pegged to the US dollar's value. However, there was no definitive timeline for implementing the new rules, and poor economic conditions in much of the post-war world made remedying balance of payments issues under a fixed exchange rate regime difficult without some current account exchange controls and external sources of funding. While the Bretton Woods system was ultimately dissolved in the 1970s, it also led to the creation of two important international organizations, the International Monetary Fund, also known as the IMF, and the World Bank, which remain in operation to this day. The IMF promotes global economic growth and financial stability. Sorry about that one. While the World Bank aims to reduce poverty by offering assistance to middle income and low income countries. Maybe, if you believe the tape, as they say. Okay, there you have it, our story of the week. A lot more to come on that. I will absolutely be doing a whole episode on the creation of the Bretton Woods system. Get into that, save that for another day. And then, okay, here, let's get into our quote of the day. One of my favorites. I swear by my life and my love of it that I shall never live for the sake of another man, nor ask another man to live for mine. And that was from John Galt, one of my favorite fictional characters of all time from Atlas Shrugged. If you've never read Atlas Shrugged, I suggest you read it. It will change your life. I guarantee it. Who is John Galt? That's a question. Maybe that should be the question of the week. Who is John Galt? Go read that one. But John Galt, one of my favorite fictional characters of all time. Great quote. So, okay. So with that, I thank everybody for joining me tonight as another fantastic night. Don't forget, we have episodes that come out every week, Monday through Friday. You usually drop at 12 noon. Episodes are short. They're only about, 10 to 20 minutes in length on average. So, easily digestible every day, no matter what you're doing. Maybe just listening to and from your way to work. If you're sitting on a train for a little bit, riding into work or something like that, some good stuff to listen to. But yeah, so check out those. Remember, we'll be back here again next Saturday night for another Strategy Room live stream. Please make sure to like, share, and subscribe. That always helps the channel. Please be sure to leave your comments, as I always love getting back to everybody. If anybody wants a t-shirt, ask me, check out the t-shirt. That's kind of a joke, and but yeah. So again, please, remember to check out the BankerNextDoor.com. Please check out some of the other videos on the channel, as I've got a ton of content out there right now for everybody to check out. Check out the Lords of Easy Money series, the crypto series, all the interviews I've done. Documentary and movie that I've covered, things like that. So a lot of great different stuff on the channel for people to check out. But with that, I hope everyone has an awesome day. Oh, and one last thing, I have to give a shout out to my mom. Happy Mother's Day, Mom. I know you're going to have a great Mother's Day tomorrow. And I would wish a happy Mother's Day to all the mothers out there. Have a great Mother's Day tomorrow. And I hope everybody has a great rest of the weekend. See everybody later. Take care out there.